There are two big trends playing out in the United States right now: work from home and a flight to the suburbs. Want to profit from that? Would you like to know about a high quality stock that is poised to benefit tremendously from both trends? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel. I'd really appreciate it. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is selling high-end home products and furnishings. As work from home and the flight to the suburbs plays out, we can see that home sales are rising. People are moving from cramped urban spaces to larger suburban spaces. This means more home furnishings to fill those larger spaces. And for this company, that means more profit and dividends. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of WILLIAMS-SONOMA Inc., which appear to be trading at a significant discount today. WILLIAMS-SONOMA Inc., stock ticker WSM, is a nationwide multi-channel retailer of high-quality home products and furnishings. Founded in 1956, WILLIAMS-SONOMA is now a $6.7 billion by market cap company that employs more than 19,000 people. Their enviable brand portfolio includes Pottery Barn, West Elm, and the eponymous WILLIAMS-SONOMA. The company reports results across two channel segments: e-commerce, 56% of fiscal year 2020 sales, and retail, 44%. Roughly 94% of their sales occur in the United States. In order to thrive in today's retail environment, you need two things. First, you need a strong brand or suite of strong brands to differentiate yourself, maintain a loyal consumer base, and protect margins. Second, you need a coherent and complementary omni-channel strategy where you take advantage of both e-commerce and physical retail to delight your customers. Well, WILLIAMS-SONOMA excels at both. They have coveted brands, and they developed a very effective e-commerce channel in anticipation of a changing retail landscape, as evidenced by their split in sales across channels. All of this puts them in a great position as the two big aforementioned trends play out in the United States. If more people are moving to the suburbs and working from home, that means larger homes and more furnishings to fill those spaces. This bodes well for increasing profit and dividends for WILLIAMS-SONOMA. As it sits, the company has increased its dividend for 14 consecutive years. The 10-year dividend growth rate is 14.6%. This double-digit dividend growth comes on top of the stock's market-beating yield of 2.1%. With a payout ratio of only 20.8%, the dividend is easily covered by earnings. The only criticism here is the skipping of the normal dividend raise cycle back in March. That was when the pandemic was just starting to take hold. I suspect the company will get back to dividend growth shortly. Looking at business growth, WILLIAMS-SONOMA increased its revenue from $3.504 billion in fiscal year 2011 to $5.89 in 2010. That's a compound annual growth rate of 5.96%. Strong. I usually like to see mid-single-digit top-line growth rate from a business like this, and they're delivering. Notably, there wasn't a single year over the last decade in which this company did not grow its revenue year over year. There's clearly secular growth here. Meanwhile, earnings per share compounded from $1.83 to $4.49 over this period, which is a compound annual growth rate of 10.49%. Very impressive. Buybacks helped to propel much of this excess bottom line growth. The outstanding share count is down by approximately 28% over the last decade. Looking forward, CFRA believes WILLIAMS-SONOMA will compound its earnings per share at an annual rate of 9% over the next 3 years. They cite the ongoing work from home dynamics, a digitally led business model, the vertically integrated supply chain, and favorable demographics as reasons to have a positive view. Regarding that last point, while unemployment remains chronically high in the United States due to the shutdowns, the demographic that WILLIAMS-SONOMA targets has not been as impacted. I think CFRA's forecast is actually conservative. There's a lot of economic uncertainty at this moment, that is sure. However, WILLIAMS-SONOMA could disproportionately disproportionately benefit from the work from home and urban flight trends. Moreover, Williams-Sonoma has grown its earnings per share much faster than 9% over the last decade. If CFRA's 9% earnings per share growth projection is realized, the dividend is positioned to grow at least this fast, if not faster, due to the modest payout ratio. But we could be looking at a much better scenario here. Moving over to the balance sheet, the company has a phenomenal financial position. The balance sheet is a fortress with no long-term debt. This gives the company more flexibility, and it also allows for more capital returns to shareholders. Profitability is fairly robust for a retailer, bolstered by the value of their brands. Over the last 5 years, the firm has averaged annual net margin of 5.81% and annual return on equity of 25.96%. Overall, I think Williams-Sonoma is an underrated way to play the two big trends playing out in the United States. Even before these trends arrived, this company was doing incredibly well. Yet they're in a position to do even better. With sought-after brands, a successful omni-channel strategy, scale, and vertical integration, the company does have competitive advantages. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. Regarding competition, the home furnishings industry is particularly competitive. The lack of switching costs is also a risk. The company has direct exposure to housing. If home sales fall, demand for luxury home furnishings will naturally decline. And while they've moved faster than most of the competition in terms of their omni-channel strategy, there's always the possibility of some erosion of this timing advantage. With these risks known, I still think this looks like a great long-term investment, but the stock has to be bought at the right price. Well, I think the valuation here is actually pretty attractive. The stock is trading hands for a price-to-earnings ratio of 17.4. That's much lower than the broader market. It's also slightly lower than the stock's own 5-year average PE ratio. Unlike some other stocks that feature low PE ratios right now because their stock prices have collapsed, this is a different story. The stock is up well over 200% from its 52-week low. On the other hand, earnings have also been strong. The fiscal year 2021 second quarter report showed diluted earnings per share that doubled year over year. The price to cash flow ratio of 8.3 is below its 3-year average of 9.0. And the yield, as noted earlier, is better than what the broader market is offering. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 8%. That dividend growth rate is on the high end of what I normally allow for, but I think this is a business that deserves it. There's no debt, the payout ratio is very low, the omni-channel strategy is about as good as it gets, the positioning is excellent, trends are working to their advantage, and there's a high amount of brand value here. The long-term earnings per share growth rate is much higher than what I'm accounting for here, as is the near-term earnings per share growth projection. I think Williams-Sonoma can continue delivering. The dividend discount model analysis gives me a fair value of $103.68. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Williams-Sonoma as a 3-star stock with a fair value estimate of $81. CFRA rates Williams-Sonoma as a 4-star buy with a 12-month target price of $115. I came out roughly in the middle here. Averaging the 3 numbers out gives us a final valuation of $99.89, which would indicate the stock is possibly 10% undervalued. Here's the bottom line, guys. Williams-Sonoma Inc. is a high-quality stock that's perfectly positioned to disproportionately benefit from 2 major trends playing out in the United States right now. They've solved a lot of the problems that plague the competition, including the e-commerce paradigm shift. With a market-beating yield, double-digit long-term dividend growth, a very low payout ratio, and the potential that shares are 10% undervalued, this skyrocketing dividend growth stock still looks like a great long-term investment. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including a link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.